Welcome back to assignment number 1 in financial accounting. We are now going to work through the solutions to question number 2 of the assignment. And this one's a little bit more difficult just because we have to interpret various transactions and figure out what the account balances at the end of the period are, where the first question we were given those account balances. So just a touch more difficult, but I know you can do it. Here we want to analyze the transactions for Co-Consulting's first year of business. This lady that owns this business develops financial investment plans for young adults. So we want to prepare a formal income statement, statement of owner's equity and balance sheet for the fiscal year ending December 31st, 2014. So these transactions cover presumably the whole year of 2014. So let's get started. The first transaction, A, co-invested $120,000 in cash and office equipment valued at $10,000 into the business. So we have a cash account. Cash account increases by, if we break this down into each separate transaction, first there's $120,000 in cash. And that was a contribution to the business. So we have owner's contribution. Is $120,000. So that goes directly into equity when we get to that stage. The office equipment valued at $10,000 is a recognition that a contribution by an owner doesn't have to be cash. It can be any asset. Okay, so in this case, the owner has taken some personal office equipment and moved it into her business. $10,000. So again, that's owner's contribution. Doesn't matter that it's not cash. It's worth $10,000. So we add $10,000 to that, and we have office equipment. And office equipment is typically a long-term asset. Office equipment is something you expect to use or have use of for more than 1 year. So we'll increase that by $10,000. There are no beginning balances for these accounts because this is the first year of operation. So if you're doing this in subsequent years, then you would have to be concerned about what the balance sheet, the ending balance sheet at the start of the year was looking at, and what those account balances were to make sure you include them in your calculations. But we don't have to worry about that in this question. She purchased a small building for $240,000. So we have another long-term asset worth $240,000. And to pay for that, she used $50,000 in cash. So cash goes down by $50,000. And she borrowed a mortgage. A mortgage is a typical name for a loan used for real estate, land and buildings. So she took out a mortgage for the remainder, to be paid over 10 years. We don't really need to know about that in this case. But the mortgage then, which is a long-term liability, is $190,000. So it increases by $190,000. Now we purchased some more office equipment. We paid cash for this, so we used another $18,000 in cash, so it goes down, and we have office equipment going up by $18,000. Purchased $4,000 of office supplies on accounts payable. Office supplies is a current asset. It's paper and pens and the sorts of things that you need in an office to run it. And until you use it up, it's a current asset. So office supplies, 4,000. so that's gone up 4,000. And we bought that on credit, so there's an accounts payable also 4,000. So that transaction balances to that extent. But we're not done yet. We bought a $6,400 off office equipment on a term loan. So office equipment was $6,400, and a term loan, because again you expect office equipment to last more than 1 year, you typically will get your financing for more than 1 year, and that a good name for that is term loan. The term is 3 to 5 years, something like that normally. So term loan, 6,400. Okay, that's D. Flip the page over here. C. We paid a local newspaper $4,500 in cash for an ad in the newspaper promoting the grand opening of the business. So in this case we have advertising expense is 4,500, and we paid for that, so that's a reduction in cash, 4,500. Okay, now with something like advertising, we normally claim that right away as an expense, even though we don't know for sure what sales it's going to affect. That's the reason we claim it when it's paid for. We don't know if it's going to affect sales right away now or revenues for next year. So this is the option we take. It's called a period cost rather than a product cost. We completed and delivered a financial plan for a client and billed them $6,000 for the service. Okay, the key word here is that it was completed. So we did all of the things that we needed to do to earn this money. So we can call that revenue. Let's call that fees. And it was 6,000. Now we've done our work on that, but we haven't been paid cash yet. So we set up an accounts receivable for 6,000 because we expect our customer to pay us in the next 2 to 3 months. I co-agreed to design a financial plan for another client to be delivered in 2015 and collected the $8,000 fee in advance. So we collected $8,000 fee, so that's cash. But we've only signed the contract, we haven't done any work yet, so we haven't earned that revenue yet. We haven't earned those fees. So we have to call them unearned fees off 8,000. Okay, and if you remember our discussion in class, this is a current liability. And the reason for that is that we have the $8,000 that the client has paid us. We haven't earned it yet. And if we don't do the work as we are expected, then we actually owe this money back to our customers. We have to pay them back the $8,000. So that's the definition of a current liability, and that's where it belongs. And you'll see that when we do the balance sheet. Co withdrew $5,500 cash from the business to pay for a holiday in Europe. A holiday is a personal use, so it does use business cash. So we reduced the business cash by $5,500, and we have owner's drawings equal to 5,500. So that transaction balances in our accounts. We don't really care or need to know what the 5,500 was for. All we need to know is that the owner withdrew it from the business, and the same effect on as far as the business statements go. co-signed a $10,000 contract for the office to be painted in February. Okay. At this point, there is no transaction. It's a promise of a future transaction that we'll look at next year. But she paid a $2,000 deposit immediately. So there's $2,000 in cash that's gone out of the business. $2,000. And because we've paid that money in advance, the company still will owe that back to us if they don't do the work. So if the contract doesn't get done. Okay, so we call that a prepaid expense. Right? We paid $2,000 for work that was going to be done next year, and that work, when it's done, would be an expense. Okay, renovation expense or painting expense or something like that. So we paid it in advance, so it's prepaid. We received $4,000 from the client that we gave an accounts receivable to. So we increase cash by $4,000, and we reduce our accounts receivables by $4,000. $2,000 left. Paid for equipment that was purchased, the office equipment that we bought for $6,400. Now this is a little unusual because we took out a term loan, but she had the money available, so that was fine. So we paid $6,400, and so sorry, not that. The term loan goes down $6,400. So we pay off essentially the term loan. And finally, we paid $3,800 cash for the secretary's wages. So minus $3,800, and we don't need to worry whether it's secretary or not. We'll just call that account wages expense. $3,800. So that's all of the transactions, and we've created accounts for each of those transactions, at least 2 accounts. Sometimes we talked about 3 or 4 accounts in a transaction. That's fine. But now you go through and you calculate the balance of all of these accounts. So cash, if you add all this up, you should get $41,800, and that's the number we need to carry on to the balance sheet and so on. Owner's contribution is $130,000. That's the number. Office equipment, we have $34,400. Buildings, this is good. Mortgage is $190,000. We didn't make any payments on it. Office supplies are $4,000. Accounts payable, term loan is 0. So we don't even need to include that in our discussion of the balance sheet. Advertising expense, fees, accounts receivable, we paid $4,000 off, so we ended up with $2,000, which is the balance. And the rest of these all are just single items. But it's when I do these, I like to circle the balances, so when I go to do the next step, I'll be able to use them easily without getting mixed up with some of the other numbers. Okay, so keep these numbers in mind. I need to erase this to take a look at the next statement. Well, maybe we can squeeze the income statement off here. Let me see. So we have, let me get the name of the company right again. Co-Consulting. Income statement. for the year ended December 31st, 2014. All right, so that's the formal aspect of it. We have revenues. And there was only one revenue. We called it fees. So the fees are $6,000. So $6,000. Starting a column, and you can, if you get used to putting, total revenues. Let's do that. We'll put total revenues is 6,000, and we'll start an outside area there. It is repetitive, but the point is that if you had other types of revenues, like we did in the first question, then you would add those all up here, and then have total revenues out in a separate column. So it makes it very easy to see what the category totals are or subtotals are. Okay, take a look at expenses. Go down this list: contribution, equipment, building, mortgage, supplies, accounts payable, term loan, advertising expense. Is 4,500, 4,500. No dollar sign. We're in the same column here as we were before. Advertising expense, fees, accounts receivable, unearned fees, owner's drawings, prepaid expense. Prepaid expense is not yet an expense. It'll be an expense in the next year. So the only other one we have is wages. Wages expense 3,800. So total expenses are 8,300. Is that right? Yeah. And again, I don't know why we ended up picking two questions that had net losses. It is common in starting businesses, but don't get the sense that companies don't have net profits, but we just haven't seen them yet. Net loss is $2,300. And again, we're going to put brackets around that to make it clear that it's negative, dollar sign, double underline. Okay, so that's the income statement. Let's go over here and just erase some of this off. Okay, so now if we calculate the statement of owner's equity, so co-consulting, statement of equity, again it's for the year ended December 31st, 2014. I put it underlined under the title. It's not necessary, it's not required. I just clears up when the title is stopped for me, that's all. Beginning equity. So beginning equity on January 1st, 2014 was 0, which designates or clarifies that it's a startup business in most cases. Then we add contributions. Plus contributions were $130,000 right here. We had drawings, so less drawings or withdrawals or owner's drawings, owner's withdrawals. 5,500, and that's subtracted in this column, and plus a net loss. I use plus only because, you know, we expect the net income to be positive, but here we're adding a negative number, so it mathematically works out fine. It's probably a little inconsistent with this, but drawings are always negative, always less. So what was our loss? 2,300. So this number comes from here. Okay, so now we have our ending equity. Ending equity is $122,200. Dollar sign, double underline. Okay, that's the end of that statement. Now, if I can clear the rest of the board, and we'll take a look at the balance sheet next and finish this problem off. Here we go. Co-consulting. Balance sheet on December 31st, 2014. All right. That's enough blue. Let's go back to black. Okay, we're going to do the assets first. Okay, and once again, we're going to get more serious about classifications later, but I'll give you lots of warning, so don't worry about it just yet. If we go back to our transaction account titles, you'll remember that we had $41,800 worth of cash. Start of a column, dollar sign. We had accounts receivables of $2,000. Okay, we got paid for some of those. We had office supplies of $4,000. Prepaid expense, the painting that we paid in advance for. Until it gets done, the person we gave the $2,000 to will owe us back. So it's an asset. It's like an accounts receivable, except it's for an expense, an eventual expense rather than relating to a sale. Those are the current assets if we were going to classify them. The non-current assets are office equipment, and we had $34,400 in that category. And finally, the building, $240,000. So total assets, $324,200. Double underline, dollar sign at the end of the single column here. Liabilities and equity. Right? This is the equation. Assets equal liabilities and equity. But you don't put it on the balance sheet, the equal sign. We'll start with liabilities, always. And we have accounts payable. Of $4,000. New column. when you're doing side by side like this, it ends up being a new column. And usually you treat these different sections, even if you put liabilities and equities underneath here, which is okay as a format. Because you had a double underline here to finish assets, you would start with dollar signs again as though it were a new column. Accounts payable and unearned revenue, or unearned fees, I think we called it. Let's keep consistent with that. Unearned fees were 8,000. All right, so those are, if we were classifying it, those are the current liabilities, and the long-term liability we have is the mortgage. So next is the mortgage, and it's 190,000. So total liabilities are equal to 202,000. Equity, so we have owner's equity, or let's call that just equity. Equity, and we have owner's equity that we just calculated of $122,200. Total liabilities and equity are equal to $324,200. Double underline, dollar sign. We're done. The balances, sigh of relief. Okay. Please watch this in class next week. We will be discussing any questions that arise, in particular any issues around the marking of various things. But thank you, and I will see you in class.